Well, hello, and welcome back to Principles of Accounting 2. I'm your host, Dr. B. We are in the spring 2022 semester, 8-week course of Principles of Accounting 2, which means that we are in the second week of Principles of Accounting 2 already, if you can believe that or not, right? It's only 8 weeks, so we got a little less than a month remaining. Well, no, that's not true. We have a month and a week, month and 2 weeks roughly. This class ends officially at the end of April, and uh, you'll actually have that last week as reserved for the final exam. Um, anyway, so we're in week two already, which is module one, week two. Uh, Today, we're going to cover chapters 18 and 19. 18 is on managerial accounting concepts, very basic concepts, talking about the differences between managerial and financial accounting, which was basically the difference between principles one and two. I'll also talk about a couple of key ratios. I know you guys love your ratios. And we'll also do chapter 19, which is job order costing. I'm going to spend a lot more time on job order costing than I am the more of the overview of this course. So let's go ahead and talk about those things. When we talk about this discussion on what is managerial accounting, just keep in mind what we have going on this week. So if you open up the Blackboard Classroom week two, module one, week two, we got the two chapters. So this Sunday night, you'll have your chapter 18 quiz, chapter 19 homework. Now remember, this is an 8-week course. In an 8-week course, we are covering the same amount of content in 8 weeks instead of 16. So on average, in an 8-week course, we typically have about 2 assignments per week. So last week was a little easy, right? You know, that first week, oh yeah, introductions, all that jazz. And then you had your discussion, which I thought was good, by the way. That was week one, easy week. Weeks 2 through 8 are not easy. Right? We usually have about 2 chapters per week. So this first discussion we're going to have today is going to be on managerial accounting concepts. The second one will be on job order costing. And we'll talk about all of those good things. But I just wanted to highlight what's ahead of us. So this Sunday night, you have your Chapter 18 quiz, Chapter 19 homework assignment. Both of those things are due this Sunday night. So please, my recommendation for success in this class, just like it was in 201, is to work ahead. Okay, do your absolute best to work ahead. Because the further ahead you are, the better off you'll be. And just like before, I'll have exercises for almost all the chapters. The exercises are just for your practice, okay? You don't need to submit those to me. They're just there to help you. An exercise is just practice, yeah? So feel free to try them out. It's basically like hands-on concepts that kind of in Excel, but it's just practice. It's just practice. You don't need to submit these. They're just there to help you to better understand the content. And there's usually a couple of exercises for each chapter that I incorporated into the classroom. Last in last semester, a lot of you gave me really great feedback on that mid-semester survey, and one of the biggest things that a lot of you had said was, Dr. B, I want to see more exercises, more hands-on exercises in class. And so I hear my students, I listen to your feedback. It's really important to me. And so I take your feedback and I incorporate that into the class, right? And so almost every week you'll see exercises. The exercises, again, don't submit those. There's nowhere to submit those. They're just there for you to practice. Yeah? That word exercise means practice. So that's just for you to practice what we're learning. My recommendation for success on each quiz and homework assignment is try those exercises first and then attempt the quiz or the homework assignment. And remember, just like before, there are 2 attempts on every homework assignment and every quiz. So, and the higher of the two grades will be accepted in the grade book. So just keep those things in mind as you're working through each week. And so without further ado, let's go ahead and jump into it. So the first thing I want to talk about is what is managerial accounting. That's Principles 2. Okay, that's the Principles of Accounting 2 is based off of managerial accounting concepts. And I'll talk about the differences between Principles of Accounting 1 and 2. What is managerial accounting? We'll talk about cost. Everything in this class is built based off of cost. What is the cost of a product? How do we manufacture a product? What are all the costs that go into it? That is like the bulk of everything we're going to talk about in this course over the next 6 weeks, 7 weeks. Is we're going to talk about cost, the cost of manufacturing. When we go through examples in this course, you'll hear me talk a lot about manufacturing concepts. I know that some of you have your own business or you're looking to start your own business. And so I'll be incorporating your experience as well into some of our examples. And I'll try to make things as relatable as possible because it's important that you understand all of the various costs that go into manufacturing a product or even a service, right? And so I'm going to show you that the basis of everything in managerial accounting is based off of the cost of business, right? Or the various costs associated with running a business. And so, yeah, again, I'll try to make everything as relatable as possible. So, first, the very basics of things. What is managerial accounting? One of the biggest differences between Principles 2 and Principles 1 is that Principles of Accounting 1, that you already went through, that you all completed before you got here, right? That class was focused on developing the financial statements, the income statement, the balance sheet, the statement of cash flows, the statement of retained earnings. We talked a lot about those things in Principles of Accounting 1. We talked a lot about those things in Principles of Accounting 1. Income statement, balance sheet, statement of cash flow, statement of retained earnings. That was all we did in Principles 1, as we talked about those financial statements. In Principles 2, which is this class, we're focusing more on managerial accounting. And in this class, we're focused on other information that is used internally. It's used by managers. That's why they call it managerial accounting. We're going to be looking at financial and non-financial information for managers to make decisions about the company. And so that's why this class focuses a lot on cost. We talk about things like direct materials, direct labor, factory overhead. These are all costs that are what make the cost of a product. Direct materials, direct labor, factory overhead. These are all costs that make the total cost of a product. And we'll talk a lot about those things. But those are the types of pieces of information that managers are focused on. How do I control my labor cost? How do I control my direct materials cost? How do I control my factory overhead? We can look at reports that managers use in order to manage their costs. These reports are for internal purposes only. I'm not going to publish my total cost of making a product and put it out there for everyone to see. I'm not going to do that. That's internal information. That's what managerial accounting is focused on, is the internal information. We don't publish the cost of manufacturing stuff. Otherwise, everyone would be making the same thing at the same cost, and that would defeat the purpose of competition. Uh, so those are the kinds of things we'll talk about in this course. The concept, the framework behind managerial accounting, why do we do it, is as a manager, I need to be able to plan my business. And as I'm planning my business, I'm looking at developing new products, entering new markets, building a new factory, expanding my current operation, maintaining my current operation. These are all plans. I'm budgeting. These are all plans. In business, we plan things out before we do them. We don't just do it. It's great to have a screen printing business, making clothing and stuff like that. That's awesome. It's good. It's nice to have a business like that. But at the same time, we need to plan before we just, hey, let's create that business. Awesome. You have a plan. There's a reason why you created that business, but you got to plan it out. It's like I plan to sell these products. Here's how I plan to do it. Here's where I plan to do it. Right? That's all in the planning process. In managerial accounting, I look at my internal documents, my plans, right? My business plan, my manufacturing plan, my sales plan, etc. These are all plans. I implement those plans in business. I monitor how those plans are being implemented and executed. And then I start the control process. I control my cost. I control my service. I control how my customers are satisfied. And then from the feedback from the control process, I can start the planning all over again. And it's a cyclical process. The plan, the execution of that plan, the comparison of the actual to the budgeted performance, the control of the execution, the feedback from the control, and then back to the planning. And that's what managerial accounting is all about. These are all internal things. These are all things that we do inside the business. We don't publish this information. I'm not going to publish in my financial statement notes by costs. You'll never see that, right? It's like it's internal to the business. That's what managerial accounting is. I'm focusing on managing the business based off of internal processes, procedures, and reports. And here are the differences between financial and managerial accounting. Financial accounting, we are all about developing the financial statements, income statement, balance sheet, statement of cash flow, statement of retained earnings. And we did that for external stakeholders, right? Investors, creditors, the government, tax agencies, etc. Right? We did that for everyone else. Yeah. We published those statements. It was open and available to whoever wanted to see it. Those financial statements helped creditors to make decisions based off of risk, whether they'll loan us money or not, things like that. Right? It also helped the business understand how much taxes we have to pay. Those financial statements and financial accounting were structured based off of the generally accepted accounting principles for publication. They're always available to be audited. The information represented past historical information with a little bit of forecasting. The information affected the entire organization, and it was based off of monetary data. Sales, revenue, expenses, all of the balances on the balance sheet, assets, liabilities, equity. We also looked at things that affected retained earnings. It was all financial accounting. That was all Principles of Accounting 1. Of course, you all remember that. But in Principles of Accounting 2, which is where we focus on managerial accounting, the information we're looking at is for the internal users only. The managers, the employees, the board members, the internal decision makers. In managerial accounting, I'm looking at this information to help me as a manager to make better decisions and to control my costs. The type of reports we generate in managerial accounting are not GAAP compliant. In other words, they are not generally accepted accounting principles compliant. They are not meant to be published. They're meant for internal purposes. As a manager, I have access to that type of information quickly. There's no need for an audit on them. I use these reports in managerial accounting to make decisions. So therefore, I'm using current and some past data to make decisions that will impact the future. And the focus of things in managerial accounting are based off of things like projects, processes, and organization divisions. The vast majority of the information is monetarily based, but I do include some non-financial information like customer satisfaction. And these are the primary differences between financial and managerial accounting. Now, of course, just like in financial accounting, it's important that everything we do is open, honest, and transparent to some degree. We don't want all of our documents to be transparent, right? I don't want to tell my competitors what my costs are. That's not a good way to run business. But we do want to make sure that we're being honest. And with that, it's important to understand fraud and ethics and the impact on managerial accounting. We try to prevent fraud from happening by ensuring that our accounting system is reliable and accurate. We also make sure that we have procedures in place to protect our assets. An example of that would be I keep my cash at the bank. I have my inventory locked up overnight. I have security cameras at the front door. I'm protecting my assets, right? It's also important that the company upholds their own policies. That's, for me personally, it's important that I hold up my personal policies. You have to have standards, yeah? And it's important that the company also has standards and policies and that they adhere to those policies. We don't want a company that publishes policies and then doesn't follow them. That's not ethical. And the company should also be promoting efficient operations. One of the biggest costs in business, especially in manufacturing, is waste. We don't like waste. Waste means, oh, I have some scrap metal over there. Oh, I have some additional fabric from my screen printing business over there. That's waste. Waste is bad because it adds to our cost. And in business, we want to be efficient with our operations. All these things are important to understand ways to prevent fraud from happening in the business. Just a little bit of career information. If you're ever interested in becoming a managerial accountant, there's a lot of different careers out there in finance and accounting, as you know. I was a financial controller for quite some time, but before that, I was a manager. Before that, I was a staff accountant. Before that, I was an accounts payable. You move up and you move on. These are just some career paths within the field. The data is a little out of date. It's it's like 2019 data, so probably changed a little bit, not by much. Let's see. Okay, I'm going to talk a lot about cost. You'll hear me use the word cost extensively throughout the next 7 weeks, 6 weeks, because cost is everything we focus on in managerial accounting. It's the basis of everything we focus on. There are a few different types of classifications for cost. There are two of the most important ones are called fixed cost and variable cost. Fixed costs are costs that do not change regardless of the level of activity. Fixed costs are costs that do not change regardless of the level of activity. For example, a manager's salary. A manager's salary does not change regardless of the level of activity. The manager can be super busy or not very busy, they get paid the same, regardless of the level of activity. A manager can have a lot of employees that are selling or not selling. The manager's salary is a fixed cost. It does not change regardless of the level of activity. That is a fixed cost. Cost that does not change regardless of the level of activity. Another example of a fixed cost would be rent. Rent does not change month to month. It stays the same, usually for about 12 consecutive months. It might go up a little bit after that. Rent does not change month to month. It stays the same every month for about 12 months or so. And then it might go up a little bit. That's an example of a fixed cost. Fixed costs do not change regardless of the level of activity. So those are fixed costs. They do not change regardless of the level of activity. Variable costs, on the other hand, do change with the level of activity. An example of a variable cost would be the cost of materials. The cost of materials. Think of a screen printing business for clothing. Okay? Let's say you have a screen printing business and you print logos on t-shirts. That's a fun business, by the way. So let's say you have that kind of business. Well, you have variable costs. Your variable costs will be direct materials, direct labor, and factory overhead. Direct materials are the materials that make up the majority of the cost of a product. In a screen printing business, it's the fabric and the ink, right? So the fabric, the t-shirt, that's direct materials, okay? And the cost of each additional unit of output will increase my cost, my variable cost. So in other words, I got one job, I print the t-shirt for the customer, another job, another t-shirt, another job, another t-shirt, etc., etc. The more t-shirts I have, the higher my total variable cost is. And the more t-shirts that I'm printing, the higher the cost of my ink, the more ink I'm using, etc., right? So higher cost direct materials. Direct materials is a variable cost because the cost goes up with the more that I'm doing. The more t-shirts I'm printing, the higher my cost is. The same with direct labor. The more t-shirts I'm printing means the more labor I need to put into this. And if I have hourly employees, the more they work, the higher the variable cost for labor goes, right? The hourly wages. And the same can be said with things like utilities. Utilities are variable costs. Cost is based off of the amount of time I'm running the lights. Cost of utilities based off of the number of hours I'm running the lights. You know, if I got a bunch of machines and I'm running my machines more, I'm pretty sure my electric bill is going to be higher. It's a variable cost, which is a part of factory overhead. We'll talk more about that. Those are some examples of variable costs. So those are the two primary classifications of cost. Fixed costs don't change regardless of level of output. That's a manager's salary. Variable costs, they change with the level of output. Direct materials, direct labor, factory overhead like utilities, those things change with the level of output. Now, you heard me earlier use the word direct materials and direct labor. The word direct means I can trace it. Direct. Go directly home. That's a direct path. Right? I can directly trace the cost of materials and labor to the cost of a finished product. So when you hear me say the word direct, it means it's a direct cost. A direct cost can be traced directly to the cost of a product. Direct materials and direct labor can be directly traced to the cost of a product. Indirect costs are costs that I cannot easily trace to the product. I can't easily trace things like depreciation of a piece of machinery to one single t-shirt. I can't do that. I cannot directly trace the maintenance of a piece of machinery or the maintenance of the assembly line. I can't directly trace that cost to a single product. I can't do it, especially if I have multiple products. I just can't do it. I cannot directly trace my electric bill to a single product. I just can't do that. You know, it's impossible. It's impossible because the lights are for the whole building. It's not just for the assembly line, right? Exactly. I can't easily trace it, so it's an indirect cost. So direct costs, I can trace them directly to the product. Direct materials, direct labor. Indirect costs, I cannot directly trace. Maintenance, depreciation, utilities, those are all factory overhead things. I cannot directly trace all of factory overhead to a single product. I can, however, do it indirectly. Make sense? Y'all still awake?
Yes.
All right.
Yes, sir.
Yes.
Okay, I'm just making sure now.
Thank you for going slower for me today, Professor.
No worries, Makia. Kia, I hear you. I hear you. Okay. So we talked about direct costs and indirect costs. Direct materials, direct labor, those are direct costs. Factory overhead, those are indirect. Direct means I can directly trace it to the product. Indirect, I cannot easily trace it to the product. We also talked about, what else we talked about? We talked about, sorry, let me go back. Oh yeah, we talked about fixed and variable costs, and we talked about direct and indirect costs. Now that we have a better understanding of what those are, I want to talk to you a little bit more in detail about those costs and how they make up the cost of a product. So, if I'm making something, I'm manufacturing something. I'm just looking around, getting some ideas. Okay, here's a candle. I like candles. By the way, I like candles. Okay, here's a candle. I'm holding a candle in my hand for those of you who can't see it. Here's a candle. All right. This candle, I can trace the cost to make this candle. It's easy. How's that? Well, there's some direct materials here. There's a glass, there's a lid, there's wax, and there's a wick. Those are direct materials. A glass, wax, a wick, and a lid. Those are all direct materials. How do I know the direct materials? I can directly trace those materials to making this single candle. Okay? Those are direct materials to make a candle. The glass, the wax, the wick, and the lid. Those are all direct materials. I can also track the direct labor to make this candle. How? Well, I'm sure there was an hourly employee that was responsible for shaping the glass in the kiln, right? I'm sure there was an hourly employee responsible for making sure that the machine filled the wax and put the wick in. That's direct labor. Direct labor are the employees that were directly working on making the product, the candle. Okay? So direct labor, those are the employees, the hourly employees, directly working on making this candle, the product. The direct material, it's the glass jar. It is the wax. It is the lid and the wick. Those are all direct materials. And then there's some factory overhead. The candle was probably made in a factory, okay? And since it was made in a factory, there was probably some electricity that was used. There was a supervisor that watched the employees who did the actual work. There's probably even a sales department. That's all manufacturing overhead. I cannot directly trace those costs, remember? But I know that they existed, so that's factory overhead. I got direct labor. I got direct materials. I got factory overhead, manufacturing overhead. These are all the total costs that go into manufacturing a product. Asmara has a very good question. Asmara's question is, can indirect costs be the cost of the time an employee takes for lunch because that is a loss of productivity? No. Good question. No, because we don't pay the employee for the lunch break. Productivity is a totally different thing, Esmeralda. We don't track the cost of productivity. We track the cost of the labor that it takes to make the product. But I don't track the productivity. I track everything else. Good question. The straight answer is no. Any other questions on the total cost of making a product? Does it make sense?
Yes, sir.
All right.
Yes.
Thank you, Mike. Thanks, Kia. All right, cool. So remember, direct materials and direct labor, those are direct costs. I can directly trace them to the cost of manufacturing. Manufacturing overhead, it's indirect. I can't trace the whole thing to one product, but I can broadly apply them to the cost of a product. We'll talk a lot about that. Factory overhead gets a little confusing at times. In addition to the cost of manufacturing the product, we also have this thing called period costs. Period costs are costs that are not directly attached to the product, but they're related. Okay, period costs. During the month, I probably sold some of these candles. Okay, and so there were some selling costs that were related to selling those candles, such as delivering them to the customer. There was also probably some administrative costs associated with selling the candle. Those would be things like I gotta pay my accountant and my office staff, my HR people. Those people gotta get paid. they're not directly related to manufacturing the product, but they are related to the process. So I have selling costs and administrative costs. We call those period costs. Selling and administrative expenses are called period costs. They're expenses that are not directly attached to the product, but they're related. Here's a nice, what do they call these things? Flowchart. I like those. Okay, so here's a flowchart, an example of a flowchart. We have costs that were incurred during the year. The cost can either be classified as period expenses or as product costs. Remember, product costs are direct materials, direct labor, and factory overhead. Those costs are associated with the product. Period costs would include things like selling and administrative expenses, not directly attached to the product, but still costs that were incurred. Costs associated with the product would be the inventory. Inventory is the amount of materials that we have that are used in the process of manufacturing the finished good. There are 3 different types of inventory that we'll be talking about over the next few weeks. We have raw materials, work in process, and finished goods. Here's how I want you to think about this course as we move forward. Think of it from the perspective of manufacturing. More specifically, I want you to think about an assembly line. Think about like how a car is made. Okay, a car. So the car doesn't just magically appear from the car ferry. The car ferry is not delivering cars. Okay? No, there's no car ferry. That'd be cool, but there's not. So, because there's no car ferry, they're manufactured. So the way it works is that we start with this thing called raw materials. The company will say, I don't know, GM, General Motors, will purchase raw materials from their vendors. Steel, aluminum, engine components, etc. Rubber for the tires. Those are all raw materials. They're just simply pieces of steel and aluminum and rubber tires. Those are all raw materials to manufacture a car. So General Motors will buy those from their suppliers. They come in to the factory and they're stored in like a separate warehouse or what we call a storage yard. And the storage yard is where all my raw materials are. And when I get ready to manufacture a car, one of the first things I do is I fill out what's called a requisition form. The requisition form allows me to transfer raw materials into what we call work in process. Work in process is the assembly line. And so we take all the raw materials out of the yard and we put it into work in process. The car starts the manufacturing process. So we start shaping the frame. And then we start sculpting the shell of the car. And then we start putting the engine into the car. And then we start putting the doors on and putting the wheels on. And it goes down the assembly line, right? It moves down the assembly line. Starts out as nothing. It starts out as raw materials. And then it moves through the assembly line. And it becomes a car. And there's different stages, right? Somebody's on the line, they're putting the frame together. The next person is putting the shell together. The next person is putting the doors on. The next person is putting the wheels on. The next person is screwing in a couple light bulbs. The engine's in it. Then it goes on to paint, and then it becomes a finished good, right? It goes through the assembly line process. So the way to think about it is everything starts as raw materials. Then it goes into work in process, and then it becomes a finished good. So it comes out of raw materials into work in process, and then out of work in process and into finished goods until it becomes sold. When it's sold, it becomes cost of goods sold on the income statement. So you can kind of get a good understanding of how that physical flow of cost works, the physical flow of inventory. So now that you have that in your mind, you can kind of understand how the cost structure flows, right? And so when we talk about raw materials, work in process, and finished goods, I'm talking about inventory. We, at the end of each accounting period and of each month, we take a physical count of what we have in raw materials, work in process, and finished goods. And the reason why we do that is because we need to control our cost and be able to say, oh, we're running a little low on those raw materials. We better start purchasing some more. It's like, oh, we have too much inventory and finished goods. Better slow down the work in process, so we can sell through our finished goods. These are the types of managerial decisions we make based off of this information. So just think about, as we're talking about cost, think of an assembly line. All right. We talked about a couple things, fixed costs and variable costs. We talked about direct costs and indirect costs. We also talked about product or period costs. So here's a couple of examples. Bicycle tires and wheels to make a bicycle. Actually, let's say all of this is to make a bicycle, okay? We're a bike company. We're manufacturing bicycles, yay. Okay, bike tires and wheels. Those are variable costs. The reason why they're variable costs is because those costs will go up or down depending on the number of bikes I'm making. It's a direct cost. It's a direct cost because it makes up the majority of the cost of the bicycle. And it's a product cost because wheels and tires are part of a bicycle. But you see how that works, right? It's like we can identify what is direct, what is indirect, what is variable, what is fixed, if it's a period or a product cost. Wages of an assembly worker. That's a variable cost. Remember, they're hourly employees, typically. We know, and we know it's a direct cost. How? They're an assembly worker. They're putting the bicycle together. They're directly working on the bicycle. Direct cost. And it's classified as direct labor, so therefore it's a product cost. Advertising. That's a fixed cost. Why is it fixed? Because I can purchase a TV ad and it's just the one price. It's an indirect cost. I cannot tie the TV ad directly to that bicycle. I can tie it to the company, but not the bike. And it's a period cost because it's related to the bike, but it's not a part of the bike's cost. And as Mara has a great question, advertising is fixed. The reason why it's a fixed cost and not a variable one. So advertising can be done, it can be done a lot of times, like you said, throughout the season, we'll say. But it's a fixed cost. The price of the TV ad isn't going to go up and down based off of the level of output. You see what I'm saying? Like the more bicycles I manufacture is not going to affect the cost of the TV ad. Those are they're way too separate, right? So the reason why advertising is fixed and not variable is because, remember, the definition of a variable cost. the word variable means the cost changes with the level of output. So the more bicycles I make has no relationship to the TV ad. Make sense? Yes, Mary? Hopefully that kind of clarifies it. Cool. Great. Thank you. Great question, by the way. Okay, and here's where it gets also different. And I gave this example earlier, and I'm going to give it again. Production manager's salary. Manager's salary is fixed. They get paid the same amount regardless of how many units is made by their employees. It's an indirect cost. The manager's salary is an indirect cost. Here's why. The manager is not the one making the bicycles. It's the assembly workers that are doing that. And so because the assembly workers are the one making the bicycles, I can trace their cost to the bike. I cannot trace the production manager's salary because the production manager oversees the whole operation. Therefore, it is an indirect cost. It's still a part of the product cost, but it's an indirect cost. Office depreciation. Depreciation is a fixed cost. You guys know that. We talked about that in Principles of Accounting 1. Principles of Accounting 1, we talked about depreciation. Depreciation is a fixed cost. It depreciates the same amount each year, every year, blah, blah, blah. It's fixed. We know what the cost is. It does not change with the level of output. But it's indirect. It is a part of factory overhead. And it is a period cost for office depreciation. Factory depreciation, on the other hand, like depreciation of the piece of machinery used to on the assembly line, that, on the other hand, is a product cost. Factory depreciation. Office depreciation is like a printer. The printer ain't got no bearing on the manufacturing of a bicycle. The factory equipment does. That's where that difference comes in. Oh, this one's important, and I need you to understand this one. Oil and grease applied to the gear change on the bicycle. I know it sounds minuscule, right? It is. I put a little oil on the chain to grease the chain up, to get the chain to move properly around the gears, to rotate the wheels on the bike through the pedals, right? The oil that goes on there makes up a minuscule amount of cost. It's variable because, again, based off of the number of units I produce. It's indirect. This is where it's different. It's indirect. The reason why oil and grease that is applied to the bicycle is indirect cost is because it's a very small amount of the cost. And I cannot directly trace a whole gallon of oil to one bike. I could probably trace it to a lot of different bikes for a lot of different reasons. That's why it's indirect. So when something's like a small component, like even with a candle, right? With a candle, the wick, that can either be direct or indirect. The reason why it might be indirect is because, I mean, it's a wick. What is that? Maybe less than a 1 penny of the whole candle, right? So it might be indirect in that case, especially if it just makes up a small amount of the whole cost. Just things to think about. Everyone kind of gets a good understanding of how we classify these costs, right? Okay, all right, great. You can do the same thing for service companies. So Zach, he works in the service area. So restaurant business, Zach works in the restaurant business, bar business, if you will. And it's a service. right? It's a service business. We service our guests, just like a hotel or an airline. You're servicing guests. It's a service business, right? A guest or a bar or a restaurant, a bar, an airline, a hotel. They're all service businesses, right? Uh, you're providing a service, right? You're providing services to your guests. So we can apply a lot of the same types of cost to those service businesses. For example, beverages for a airline are variable. That's a variable cost. Why? Because it's based off the number of passengers. Number of passengers changes. It's a variable cost. The same could be said with Zach's bar business. Okay, Zach's bar business, a variable cost would be. Let's think about that for a second here, Zach. A variable cost might be like the soda, for the soda gun, the soda for the soda gun. All right, at the bar, that is a variable cost. Well, the reason why it's a variable cost is because it depends on the number of drinks that customers get with soda. Hey, makes sense? Say it. Go ahead.
Oh, I was saying, yep, that's right.
Cool. Yeah, so remember, it's a variable cost if the cost depends on the level of output. This is pretty typical. So when you think about the cost of a product, this is pretty much the breakdown of it. 45% of the cost of a product comes from direct materials. 15% of it comes from labor, and 40% of it comes from factory overhead. This is like your typical cost structure breakdown of a product. You heard me talk a lot about direct materials. Direct materials make up the majority of the cost of a product. For example, my candle, I got my candle here. The glass, the lid, the wax, those are all direct materials. They make up the majority of the cost of the product. And those direct materials started as raw materials. They started as raw materials of just being glass, right? Some soy, maybe. Some wood, the lid. Glass, soy, and wood. Glass, soy, and wood are my raw materials to make a candle. Okay? Glass, soy, and wood are my raw materials to make a candle. They're raw materials. Why are they raw materials? Because they have not yet been processed in the work in process to then make a finished good, which is the finished candle. So direct materials are the materials that I can directly trace that make up the majority of the cost of the finished good. I'll give you my candle example. A bike, the frame, the steel frame. Direct labor. Direct labor, these are the wages that I can tie directly to the manufacturing process. Going back to my candle, an employee had to shape the glass. Heat up the glass, shape it into a glass. An employee had to heat the soy up to create the wax, the candle. An employee had to create the lid and slap the labels on it. So, direct labor are the employees that directly work on making the product, the assembly line employees. and I can directly trace their labor wages to that process. That's what direct labor is. Factory overhead, these are the costs that I cannot directly trace, but they're a part of the process. Factory overhead are the costs that I cannot directly trace, but they are part of the manufacturing process. An example of that would be indirect labor. The maintenance person who fixes the machines, or the maintenance person that cleans the area. That's indirect labor. The maintenance person is not building the candle or the bicycle. They're just there to take care of making sure the machine's running properly and making sure that it's clean. But they're still part of the process, so it's indirect labor. Indirect materials. The wick for the candle, that's an indirect material. Why is it indirect? Because it makes up a very small amount of the total cost of the candle. Or in the earlier example of the bicycle, indirect material, the grease for the chain, indirect material. The utilities, keep the lights on for the factory, that's indirect. And the supervisor's salary. Remember, the supervisor is responsible for managing the whole operation. So I can but they're a part of the operation. So I can track indirectly that cost for the product through factory overhead. So direct materials, direct labor, factory overhead. Those are the three primary things, three primary costs that make up the total cost of a product. Direct material, direct labor, factory overhead. Here's some more classifications. We have what we call prime costs and conversion costs. Prime costs, think prime time, hey baby, prime time. Prime costs, they make up the majority of the costs. They're prime costs I can directly trace. Prime costs make up the majority. We call those prime costs. And we also have this thing called conversion costs. Conversion costs are costs that can be converted into partially completed units. Conversion costs are costs that can be converted into partially completed units. I'll talk a lot more about those things. So prime costs and conversion costs. We also have non-manufacturing costs. These are just expenses that are on the income statement, like taxes, supplies for the office, consulting fees. Those are all just expenses. They're on the income statement. We also have period costs like selling administrative expenses. Those things are not a part of factory overhead because they're not directly incurred in the manufacturing of a product. The differences. Again, this class we're going to focus mostly on manufacturers, but I want you to understand the differences in reporting between a manufacturer, a merchandiser, and a service business. A merchandiser, that's like Macy's, okay? Or that's like Amazon, Macy's, Walmart, whatever, right? The retailer, that's a merchandiser. They buy their finished goods from a distributor and then they sell them. They buy and then they sell. That's a merchandiser. A manufacturer, they buy raw materials, they put it into work in process, and they create finished goods. The merchandiser, they just buy and sell the finished goods. Okay? That's a retailer. A retailer, that's a merchandiser. There's differences in the way that they report on their balance sheet. On the balance sheet for for manufacturer, on our balance sheet, we have, just like any other balance sheet, we have cash, accounts receivable, inventory, property, plant, and equipment. Those are all assets. And then we have our liabilities and our equities, right? But the difference here is that on a manufacturer's balance sheet, for our inventory, we have raw materials inventory, work in process inventory, and finished goods inventory. Raw materials, that's my raw steel for my car business, right? That's my raw steel. That's my raw aluminum. That's my raw engine components. That's what we call raw materials inventory. It's sitting there waiting, ready to be processed, hasn't been used yet. Those raw materials inventory can either be direct or indirect. Remember, it's direct if it makes up the majority of the cost of the product. Indirect makes up a very small amount. I have my work in process inventory. Work in process, that's what's currently being done on the assembly line. I have incomplete car parts here. It's not complete yet. They're partially completed. I have a frame there. I got a mold here. I got engine here. It's partially completed, but not all the way. It's called work in process. Partially completed, not all the way completed. We took some of the raw materials. We also added some direct labor, and we added some factory overhead. That's work in process. Finished goods inventory, that's what's available and ready for sale. I finished the cars. They're sitting out on the lot to be shipped off to wherever they're going. They're completed and ready for sale. Those finished goods. Finished goods. That's how we break down the inventory for manufacturing. So remember, manufacturing, you got raw materials, work in process, finished goods inventory. For a merchandiser, retailer, there's a line item called merchandise inventory. It's what's available for sale. Right? For a service provider, like a bar, for example, you have cash, accounts receivable, supplies, et cetera, et cetera. That's the primary difference between the three types of businesses. The primary difference is always going to be inventory. Now, earlier we had said that the total cost of a product is direct materials, direct labor, and factory overhead. It's important to understand how those costs equal finished goods, or equal the cost of each unit. And it's also important to understand that once those finished goods are sold, how they become cost of goods sold. Remember, cost of goods sold is on our income statement. Revenue, sales. Minus cost of goods sold equals gross profit, minus your expenses equals net income. That's your income statement. On your balance sheet, you have your raw materials, work in process, finished goods inventory. Remember, when you sell inventory, we take it off of the balance sheet, we put it on the income statement as cost of goods sold. A manufacturer calculates cost of goods sold by taking the beginning balance, finished goods inventory, plus the cost of goods manufactured minus the ending balance inventory equals cost of goods sold. The primary difference here is how we treat the two. A merchandiser or a retailer, they have beginning balance plus cost of goods purchased. minus ending inventory. Manufacturer has beginning balance inventory plus cost of goods manufactured minus ending goods inventory. That's how you derive cost of goods sold for either a merchandiser or a manufacturer. It's the same process. The difference here, of course, is the cost of goods. Here's a couple of examples of how it can be calculated for either one. The one on the top left is for a merchandise company. One on the bottom right is for a manufacturer. For the manufacturer, which is what I'm going to focus on. Manufacturer, we start with beginning goods inventory plus cost of goods manufactured equals cost of goods available for sale minus ending inventory equals cost of goods sold. All right. The physical flow, the flow of activities, as they say. I like to think of it as an assembly line. It's really the easiest way to understand manufacturing costs is to understand how an assembly line works. In an assembly line, we start with raw materials. These are the materials that have not yet been touched in the manufacturing process. They're sitting out there in the warehouse. Oh, I got my raw steel, my raw aluminum, my engine components. Those are all raw materials. I purchase those raw materials from my distributors. When I begin to use those raw materials, I complete what's called a requisition. A requisition form is I'm requesting, requisitioning. I'm requisitioning, requesting. The materials come out of raw materials and into work in process. And I begin the work in process. Start with my beginning inventory, what I already started with work in process, plus what I requisitioned. I added in some labor, some factory overhead. Whatever's unused remains on my balance sheet. Whatever is used becomes finished goods. This is just a nice physical flow chart. I like flow charts to some degree. This one actually works pretty well. We talked about the cost of goods manufactured earlier in that first formula when we talked about figuring out the cost of goods sold, right? This is a nice breakdown of the cost of goods manufactured. How do we find cost of goods manufactured? Cost of goods manufactured tells us the amount of cost incurred during the manufacturing process. So direct materials plus direct labor plus factory overhead equals the total manufacturing cost. Plus the beginning work in process minus the ending work in process equals the cost of goods manufactured. Pretty straightforward formula. This is one of those financial statements that you'll never find in terms of like published stuff. Why? Because this is a managerial statement. A managerial statement. This is a managerial statement. This one's called the manufacturing statement or the schedule of the cost of goods manufactured. This type of report tells me as a manager the amount of the cost of goods manufactured. And it's broken out by direct materials, direct labor, and factory overhead. Then I add in beginning balance minus ending balance equals cost of goods manufactured. Basically, it's putting this formula into this format. Central. This is an example of what that would look. Direct materials plus direct labor plus factory overhead equals total manufacturing costs plus beginning work in process inventory equals total cost of goods work in process minus the ending work in process inventory equals cost of goods manufactured. Here's another little flow chart of how the information flows from one financial statement to another. The scheduled cost of goods manufactured to the income statement, balance sheet. Managerial accounting, the reason why we focus on managerial accounting, we have a whole course for it, is because we focus on things like the global economy, services, value chain, lean practices, e-commerce, and customer orientation. All of these are current trends in managerial accounting that we focus on in order for businesses to become more efficient at managing their costs. In business, we try to do everything with the customer at the center of attention. So we try to continuously improve our business operations and utilize lean accounting principles and improve technology. We try to focus more in business on maintaining high standards for our customers and for our business. High standards lead to improved processes and procedures, reduced waste, improved customer overall satisfaction, improved products, etc. High standards, very important. There's a process in manufacturing called just in time. I made that just in time. I got it in just in time. Just in time means there's a lot less waste. Here's an example. In the United States, we have General Motors or Ford or, one of those big companies, yeah? They make a whole lot of cars. And those whole lot of cars sit on a whole lot of lots. And they're just waiting to be bought. Just waiting there and waiting there and waiting until somebody buys them, right? In Japan, they don't do that. Actually, a lot of countries don't do that. They use what's called just-in-time manufacturing. And I'm going to use the example of Toyota. Toyota, another car manufacturer, this time Japanese, they use what we call just-in-time manufacturing. They receive the customer order, then they put the customer order into production. They receive their materials just in time for production. Then they complete the assembly process just in time, and then they ship it just in time to the customer. In other words, their products are not just sitting around waiting to be complete. That's why I call it just in time. A lot less waste there. Businesses are focused a lot on adding value to the process. Call this the value chain. And they utilize lean principles to increase efficiency and profits. I acquire what I need to then put it into work in process, to then sell it, and then provide services after the sale. That's what we call a value chain. We're adding value at each step. We focus a lot on being lean because we don't like to waste. Businesses are also reporting on what we consider to be their corporate social responsibility. This will include things like reporting the amount of carbon dioxide your business is releasing into the atmosphere in terms of pounds of CO2. It's important that businesses track what their impact is on employees, suppliers, society, and the natural environment. Couple of ratios. I know you've been waiting this whole time for ratios. You love your ratios so much. So here's a few of them. How well is my company using their raw materials? We call this the raw materials inventory turnover. We take raw materials used divided by average materials inventory. Average materials inventory is beginning balance plus the ending balance divided by 2. That's how you find the average. Day sales and raw materials inventory. It's kind of just like day sales and inventory. You take ending raw materials inventory divided by raw materials used times 365 days. That, my friends, is the conclusion of our introduction to managerial accounting concepts. Any questions, comments, or concerns at this point before we begin our next discussion on job order costing? You all good? Okay. I'm going to go ahead and stop the recording now. You good? Good, Mike?
Oh, good. Yes, sir.
Okay, awesome. Thank you so much. All right, stand by, everyone.